The end of the year is a time for holidays, merrymaking, and spending time with friends and family. But it may also be your last chance to save on taxes for the present year and your best chance to plan for taxes for the next year. Hello, I'm David Frederick, Director of Wealth Planning with First Bank Wealth Management. In this video, I'll be going over a few simple tips that may help you mitigate your taxes for the present year and think about taxes for next year. The holidays are about giving, and giving to charity has always been one of the best tactics to lower your tax bill. While writing a check to your favorite charity is fine, there are some more sophisticated strategies that may help you take better tax advantage of your charitable gifts. For instance, instead of giving cash to a charity, consider giving appreciated assets like stocks or bonds. When you do this, you get a double tax benefit. First, you get the benefit of the tax deduction for the value of the asset that you gave, but second, you also get to avoid the tax on the sale of the asset. Also, if you're a current retiree taking distributions from a qualified retirement account like a 401k or an IRA, consider directing your year-end distribution to a charity instead yourself. Such a qualified charitable distribution has a tax benefit of avoiding the taxable income, which is actually even more powerful than the charitable deduction itself, which has caps and limitations. If you're not sure which charity to give to, consider establishing a donor-advised fund. A donor-advised fund is a special type of account that allows you to put in charitable gifts, let those gifts sit in an account that will grow over time, and then distribute out to the acting charities of your choice when the time is right. The nice thing about a donor-advised fund is you actually get a charitable deduction when the money goes into the account, not when it's distributed out to the charities. All of these are steps you can take in the current year to lower your current taxes. Of course, the end of the year is also a time to consider resolutions for next year and for the future. One of the best resolutions you can do to lower your future taxes and plan for your future finances is to resolve to make contributions into a qualified retirement fund like a 401k, a 403b, or an individual retirement account, otherwise known as an IRA. Typically, these contributions are tax deductible and the assets grow tax deferred. Now, it may be too late in the year to make a contribution to a 401k or a 403b, but resolving to do so in the future may be a way to help mitigate your future taxes and put you on a sound footing for your future retirement. If you don't have access to an employer fund, then you may be able to contribute to an IRA, an individual retirement account, as late as April 15 of next year and still take a tax deduction for this year. These have been a few simple tips to help you consider how to lower your taxes for this year and into the years to come. If you'd like to discuss these strategies or other financial planning ideas, please reach out to a financial professional at First Bank Wealth Management. You can reach me directly at david.frederick@fbol.com. Thank you, happy holidays, and have a happy new year.